Welcome to another episode of Who Said What. I know I missed last week's episode and no one asked why, but here I am anyway. If you're tuning in for the first time, welcome. In this show, I take comments from notable figures, break them down, and dive into the bigger stories behind them. Today, I've got 4 interesting comments for you. So, the economic survey is out. For those who don't know, it's basically the government's report card on the economy. It doesn't just look back at how the economy performed, it looks forward. The chief economic advisor, V. Ananta Nageshwaran, uses this document to highlight what's going right, what's going wrong, and what needs fixing. It's one of the most important documents for anyone who wants to understand where India is headed. So Bhuvan, who's the boss of this channel, was going through this year's survey and something struck him. Right there in the first 10 pages. The CEA wrote this. One of the refrains in the Draghi report is the China challenge to European competitiveness. It is no less for India. Several commentators have recently written about the manufacturing colossus that China has become in the last 6 years. Our chief economic advisor is drawing a comparison between India and Europe. And not just any Europe. We're talking about a Europe in crisis where productivity is flatlining, innovation is lagging, and industries are struggling to compete. It's rare for India, still an emerging economy, to be compared with a developed region like Europe on such serious economic challenges. That too in the first few pages of the survey itself. That's a point of concern. He's basically telling us that India could be heading down the same path unless we wake up. So what's this Draghi report all about and why does it matter to us? But let me give you some context first. Think of Mario Draghi as Europe's fixer. You know Winston Wolfe from Pulp Fiction? He's the guy you call when things go south and you need someone to clean up the mess.
I'm Winston Wolfe. I solve problems.
That's what Draghi is for Europe. He's the former president of European Central Bank and the man who saved the euro during the debt crisis. Now Draghi had written this report that lays out exactly why Europe is struggling and how it can claw its way back to competitiveness. His diagnosis is brutal. Europe is at the risk of long-term economic stagnation. Productivity is stuck, innovation is weak, and industries are overregulated and underinvested. Sounds familiar, right? It should, because a lot of issues that Draghi highlights, productivity bottlenecks, dependence on foreign tech, weak investment, are directly relevant to India. Draghi's new plan for European Union calls for a massive yearly spending of 800 billion euros to strengthen Europe. That's 7,22,000 crore in Indian currency. He wants to make business rules the same across all European countries and reduce Europe's dependence on other nations for critical supplies and tech. Let me break down the key areas he identifies and I'll tell you how these problems mirror India's own challenges. The first one, productivity stagnation and market fragmentation. Draghi opens with a warning. Europe's productivity is flatlining. In the 1990s, Europe's productivity growth almost caught up with the US, but since then it has stalled. The reasons are Europe failed to ride the tech boom that fueled US growth and its internal markets are too fragmented. Different countries have different regulations, creating what Draghi calls hidden tariffs. These barriers stifle businesses, especially in services, preventing them from scaling across the EU. India faces a similar problem. Even though it's an earlier stage of development, reforms like GST were meant to unify the market, but businesses still face state-by-state regulatory hurdles. For example, logistic companies have to navigate a maze of state-level permits and compliance requirements. Infra projects often get stuck due to inconsistent land laws across the states. Second, the innovation deficit. In the global innovation race, Europe is falling behind. The US and China are pulling ahead in critical technologies like AI, semiconductors, and clean energy. Europe's problem is twofold: low R&D investment and a risk-averse financial system. Startups in Europe struggle to raise venture capital and rely too heavily on bank loans, which aren't suited for risky, high-growth innovation. India has its own version of this issue. While Indian tech startups have made headlines, long-term R&D spending is still less than 1% of the GDP. Sectors like electronics manufacturing and EV technology remain dependent on imports. And while India's VC ecosystem has grown, growth stage funding for deep tech innovation is still limited. The third one, the China challenge. Draghi points out that Europe is dangerously dependent on China for critical raw materials, especially those needed for renewable energy. China dominates the global supply chain for solar panels, batteries, and rare earth metals. This puts Europe at a risk of supply chain disruptions and price shocks. India faces the exact same challenge. As we push for clean energy, we're still importing the bulk of our solar components from China. Supply chain issues during the pandemic exposed how vulnerable India's renewable energy projects are to external shocks. Fourth, ease of doing business. Draghi emphasizes that Europe's complex regulatory framework is stifling business growth. Different countries have different rules, making compliance a nightmare. Draghi argues that bureaucratic inertia is one of Europe's biggest obstacles to competitiveness. India's experience is strikingly similar. While we have improved in the ease of doing business rankings, red tape is still a major headache for entrepreneurs. Small businesses face multiple layers of compliance that slow down operations and discourage investment. Draghi's recommendation is simple. Government needs to get out of the way. The CEA also spoke about the deregulation in the economic survey, saying, lowering the cost of business through deregulation will make a significant contribution to accelerating economic growth and employment amidst unprecedented global challenges. Fifth, defense spending and economic security. See, defense may not seem like an economic issue at first, but Draghi argues that it's critical to long-term security and competitiveness. Europe's defense budgets have been constrained by fiscal pressures, leaving it reliant on US military support through NATO. India's defense challenge is different but equally pressing. We face a dual front threat from China and Pakistan, yet much of our defense spending goes towards personal cost rather than modernization. Without investments in advanced defense technology, we risk failing behind in a critical area. Sixth one, public and private investment. As I said before, Europe has underinvested in infra and tech for years. As I mentioned earlier, Draghi had proposed a massive 800 billion euros annual investment plan to drive growth. However, he warns that this requires both public funding and private sector confidence. India faces a similar challenge in infra financing. While programs like Bharat Mala have increased public investment, many projects are delayed due to funding gap and bureaucratic hurdles. India needs to strengthen public-private partnerships and attract more long-term foreign capital. These are some of the major points from Draghi's report. What's clear is that India has no doubt come a long way, but there's still a long way to go. The fact that the chief economic advisor highlighted Draghi's report within the first 10 pages of the economic survey should not be taken lightly at all. It's a reminder that the same cracks appearing in Europe's economy could threaten ours if we don't act quickly. Draghi's message is clear. Competitiveness isn't guaranteed, it's earned. The question is, how will India respond? Now for the second story. There's always a lot of talk about which stocks are hot in the market, and Zomato often pops up in those conversations. Recently, Anurag Singh, MD of Ansit Capital, made some strong comments about it. In an interview with NDTV Profit, he said,
"Now here is the reality. What you are buying is a 1 rupee stock."
Basically, he's saying that early investors, especially private equity, made huge returns, and now retail investors are left with a stock that's priced way too high. But is Zomato really overvalued? Well, maybe yes. If you look at the price to earning or the PE ratio, it is somewhere around 300, which is extremely high. If you look at this graph, the stock is down close to 30% from its peak. But is it actually a 1 rupee stock? That feels like a bit of an exaggeration to me. The thing with growth companies like Zomato or even Swiggy for that matter is that they aren't valued based on how much money they are making right now. People bet on what the business could become in the future. Some might say narrative defines the price of the stock. Sometimes that story can get ahead of the reality, and that's exactly what Anurag is questioning here. This is something I understood from the Dean of Valuation, Ashwath Damodharan. He had valued Zomato at 41 rupee per share back when it IPO'd in 2021. At the time, he wasn't convinced that India's food delivery market could grow fast enough to justify the hype. In an interview with LiveMint, he said, when you pay 10 times revenues for Paytm or Zomato, you're making judgments about what the total market will be and what their market share will be, but you're not explicit about it. He acknowledged that businesses evolve, sometimes in unexpected ways. Zomato's acquisition of Blinkit, which many including Singh criticized, may not have been such a misstep after all. Blinkit gave Zomato an entry point to extend beyond food into quick commerce, potentially positioning itself as a logistics player rather than just a delivery app. But Anurag Singh isn't buying this argument. He calls Blinkit just an exit to private equity implying that Zomato overpaid to bail out investors. He also says that Zomato's management is just buying the top line and creating a top line illusion, meaning that they're using acquisitions to boost their revenue numbers instead of focusing on organic growth. His concern is that Zomato's business model will keep burning cash for years. Here's what he said.
The story is they're just buying top line and creating a top line illusion. The money is not going to be made on this because this will be a constant cash guzzler.
Another issue Singh raises is Zomato's valuation. It's currently around 1.4 lakh crore or $17 billion. For comparison, DoorDash, which operates in a much larger US market, has a market cap of roughly $35 billion. Singh questions whether Zomato should be valued so highly. He says,
Tamanna, compare DoorDash out here in US. It's valued at 70 billion. I haven't seen any sector play where somebody is going to reason out that an Indian replica of a US player is half the market cap of a US company. That has not worked out in any sector.
Damodran has also commented on this valuation comparison. He noted that while DoorDash has larger average order values or AOV and more mature online habits, Zomato faces different challenges and opportunities. Damodran says, in India, time and traffic issues can give companies like Zomato a competitive edge. People are willing to pay for convenience here. This creates a scenario where Zomato's success may not rely solely on food delivery. It could become a broader logistics player that solves real urban problems. Even with this potential, Anurag Singh remains unconvinced about the upside for investors. He predicts that by 2030, people will be sitting on 2 to 3x returns, far less than what most expect from high-growth tech stocks. Adding to the tension, Zomato's recent quarterly results didn't inspire much confidence. The company posted a profit decline of over 50%, frustrating investors who were hoping to see stronger performance. So what's next for Zomato? Investors are caught between two narratives. On one side, there's Anurag Singh's view that the stock is overhyped and overpriced. On the other side, Damodran suggests that while the valuation may be steep, Zomato could evolve into something bigger, possibly a dominant logistics player in India's future economy. As Damodran himself said, quoting Keynes, "When facts change, I change my mind." Investors might want to keep that in mind as Zomato's story continues to unfold. Now for the third story. See, there's been a lot happening in the oil sector lately, and I didn't quite realize the full extent of it until I wrote a story about it on the Daily Brief. Since then, I've come across more insights, including a conversation with India's oil minister Hardeep Singh Puri on CNBC. He made an interesting observation about Guyana that caught my attention.
I have said so on many occasions, not so often on record in the public domain, but in my discussions with my bilateral colleagues. I've very often told them, look, you've got a major find like Guyana. Now, obviously, somebody's marketing that oil for you.
Now, what does he mean by that? Why is Guyana's oil discovery a big deal? To understand that, you need to know how OPEC came into existence and why they might be losing sleep over new oil discoveries in places they don't control. In the 1960s, Saudi Arabia, Iraq, Venezuela, and other key oil-producing nations created OPEC. At the time, Western oil companies referred to as the Seven Sisters had a near monopoly on oil production, dictating terms to resource-rich nations. OPEC was formed to wrest back control over pricing and production of oil. Fast forward to today, and OPEC controls around 40% of global oil production and holds roughly 80% of world's proven oil reserves. That gives them a significant market influence. Later, OPEC Plus was formed by including other major non-member producers like Russia and Kazakhstan to further coordinate production cuts or increases. But despite these efforts, their influence is weakening. And the reason? Oil is now being discovered and extracted in non-OPEC countries like Guyana and Brazil. Guyana, in particular, has rapidly scaled up production thanks to the major investments from ExxonMobil. It is projected to produce 1.3 million barrels per day by 2027. This is outside of OPEC's control, and it dilutes their ability to manipulate global prices. OPEC Plus has been aggressively cutting production by around 6 million barrels per day from 2022 through a series of cuts in an attempt to reduce supply and push prices higher. But it hasn't worked. Oil prices have been stuck around $72 to $73 per barrel. Hardeep Singh Puri addressed this challenge, saying,
The fact of the matter is there's more oil coming on the market from some of those sources than they would want. Now, their decision to cut back is essentially on account of their desire to maintain the price level. They think for balancing their budgets, they need something like $80 a barrel. Today, the price seems to be heading more towards 70, 72 rather than 80.
This presents a serious problem for oil-dependent economies. Saudi Arabia, for example, needs oil prices above $96 per barrel to balance its budget. According to Rory Johnston, an oil expert, the situation is even more challenging when you account for the kingdom's Vision 2030 spending priorities. Johnston highlights that much of this spending is funneled through Saudi Arabia's Public Investment Fund, leading Bloomberg to estimate the fiscal break-even price for Saudi oil to be over $100 per barrel. Seems like since Saudi Arabia's bet on VWAC failed, they're now focused on squeezing every drop of oil revenue they can. OPEC struggles aren't just about new competition from producers like Guyana. Several broader factors are keeping prices low. The first, oil being discovered in new regions. Countries like Brazil and Guyana have scaled up their oil production in recent years. With more oil flooding the market, OPEC's production cuts are not enough to counterbalance this supply glut. This is creating a global surplus which suppresses prices despite the output reductions. Second, the global demand might be weakening. See, the global economy isn't growing as fast as expected, particularly in major oil importing regions like Europe. The recession fears, tightening monetary policies, and sluggish industrial output are all contributing to softer oil demand. Third, China's potential peak oil moment. See, China is a critical player in global oil markets. It imports vast amounts of crude to fuel its industries and vehicles, but that demand might have peaked. Since there is not enough construction now, the demand for oil has also been going down there. The country has also been aggressively transitioning to EVs. In fact, 60% of global EV sales happens in China, and by 2030, that figure might reach 75%. This shift is reducing gasoline demand. Additionally, China is replacing diesel trucks with LNG-powered trucks, further cutting demand for oil. As Hardeep Singh Puri put it,
But the point is, if a large economy like China is reaching a point of satiation, I should use the word saturation, but I think they're satiated because they have their own, their vehicular traffic is moving to EV, but that EV is tied to thermal.
Yeah.
So how much more oil can you sell?
but it's not just EVs. See, as I mentioned earlier, China's construction sector, which consumes large amounts of diesel, has slowed down considerably. Combined with weak overall economic growth, this is putting further downward pressure on oil demand. OPEC's control over oil prices have always depended on balancing supply and demand. But with so many variables at play, new discoveries, geopolitical shifts and declining demand in major markets like China, which is the second largest consumer of oil, their grip on market is loosening. If prices remain low, OPEC may need to extend or deepen production cuts. However, this strategy has limits. Many member countries have budget deficits to manage and can't afford prolonged revenue losses. In this increasingly complex game of oil geopolitics, no one holds all the cards anymore. As Hardeep Singh Puri puts it,
But what happens if, Shireen, suddenly a lot of oil comes available? Then it becomes more decidedly a buyer's market.
Yeah.
and that's exactly what we are starting to see. And for the final story, let me talk about Ashwath Damodaran again. He recently reflected on the challenges facing active fund managers on his blog, where he analyzed US equity markets and how investment strategies like small cap and value investing have fared over the years. He noted that traditional strategies are struggling in today's market environment, which has become increasingly skewed towards large cap, tech-driven winners like Apple and Nvidia. One line, or should I say a bold statement that he says in the blog post is this: a mutual fund manager who screens stocks for low PE ratios and high growth while demanding a hefty management fee deserves to be replaced by an ETF or index fund, and that replacement will continue, pruning the active management population. Damodaran is pointing out that passive investing is clearly winning against active investing. Active fund managers are struggling to beat the market, and there's a simple reason why. They face a mathematical disadvantage. Now let me break this down for you. Imagine all the money in the stock market. Some of it is managed passively through index funds and the rest is managed actively by fund managers who pick stocks. Together, active and passive investors are the market. Now, passive investors just track the market and incur very low cost. On the other hand, active managers try to beat the market by trading stocks frequently and analyzing companies, which involves higher costs like fees, research, and trading expenses. After those costs, active investors as a group end up earning less than the market's average return. In other words, it's hard for active managers to outperform because they're competing against each other while also carrying the extra burden of higher fees and expenses. That's why studies show that over time, passive funds, which keep costs low and simply follow market indices, often outperform actively managed funds. Now, this isn't just a theory. Damodaran notes that even in the US, where investment strategies like small cap or value investing were once popular, most active managers have failed to consistently deliver better returns than their passive counterparts. In India, the situation isn't different. It mirrors much of what Damodaran describes. According to a Spiva report, Indian large cap funds have severely underperformed their benchmarks. Over the past 5 years, 100% of large cap funds fail to beat the index, and this declines to about 70% when looking at a 10-year horizon. Mid and small cap funds fared slightly better, but even there, more than half of them underperformed their benchmarks, both on a 5-year and a 10-year basis. These underwhelming results for active funds in India reinforce Damodaran's argument. Why pay high fees to active managers when a low-cost index fund can get you better returns? However, the dominance of passive investing has sparked debate over its long-term effects on the markets, particularly on price discovery. See, price discovery is a process through which buyers and sellers set market prices based on new information. Experts argue that if too many investors blindly invest in passive funds without analyzing individual stocks, prices might become inefficient. But Damodaran pushes back on this concern, explaining that markets naturally adjust. If prices were to become distorted, opportunities for profit would attract active investors who could correct those inefficiencies. He draws from economic theory, emphasizing that this balance between active and passive investing ensures that markets don't become entirely inefficient. See, Damodaran himself admits to being an active investor, not because he has special information or superior analytical tools, but because he enjoys the process. He says, even if I underperform index funds over my lifetime, I'd still be fine with that. I enjoy investing.
And you know why? Because even if I've earned returns lower than what I'd have made investing in index funds, I enjoy the process of investing. That's why I'm an active investor. And that would be my suggestion to you. I love investing and I will continue to be an active investor.
And that's all for this episode. If you have any feedback for me, please let me know in the comments below.